So imagine you're looking at a stock, right? And it rockets from a yearly low of like 13 bucks all the way to over $60.
Which is just a massive, massive move.
Exactly. I mean, the charts are screaming strong bullish phase. The momentum looks basically vertical, and the whole artificial intelligence hype train is clearly leaving the station.
Oh, I left the station a while ago.
Right, yeah.
Nah.
But, and here is the massive catch, at the exact same time, the top executives of this very company are quietly selling off millions of dollars of their own shares.
Yeah, which is always a moment that makes you pause.
Totally. So as an investor looking at this, you have to ask yourself, are you staring at an undervalued tech gem or, are you about to step into a massive value trap?
It is, well, it's the ultimate market puzzle, honestly.
It really is. Welcome to today's deep dive, everyone. We are looking at Ichor Holdings, Ltd, ticker symbol ICHR.
And this is a really interesting one right now.
Yeah, because if you are investing in AI right now, you probably looking at NVIDIA or Microsoft, the big names, but ICHR represents this pick and shovel play of the AI gold rush.
Exactly. They build the underlying infrastructure.
Right. So understanding why this specific stock is behaving this way will tell you a lot about the hidden risks in the broader AI hardware supply chain.
It's a great lens into the whole sector.
We've got a massive stack of sources today. We're talking financials, real-time market quotes from midday, April 13th, 2026, technical indicators, and all the latest analyst reports.
Yeah, there's a lot of hidden machinery to uncover here, literally and figuratively.
Definitely. Our mission today is to dissect those financials, chart the technicals, and figure out what is actually driving this wild momentum. Before we jump in, please take a second to like this video, subscribe to our YouTube channel, and we absolutely want you to leave your thoughts in the comments below.
We really do read all of them.
We do. Oh, and a quick but firm reminder before we get into the weeds. This conversation is purely an educational analysis of the provided data.
Right, this is not financial advice.
Always do your own research, folks. All right, let's establish the immediate reality here. Where does Ichor Holdings actually stand right this second?
So, looking at the midday tape for April 13th, 2026, ICHR is trading at $60.60.
Okay.
It's up 5.39% for the day. And importantly, it just broke out to a brand new 52-week high of $61.16.
Wow. And just to put that into perspective for everyone, the 52-week low was just $13.12.
Yeah, we're talking about a monstrous recovery curve here.
Anyone with eyes can see the chart going up and to the right. But, I mean, how strong is this trend, really? Is this a sustainable climb or just like a flash in the pan?
Well, to gauge that, we have to look at the technical momentum.
Yeah.
Right now, ICHR is dominating its moving averages.
Dominating in what way?
So it's trading comfortably above its 50-day moving average, which sits at $51.11. And it's also well above its short-term 5-day moving average of $57.09.
Okay, so it's clearing both hurdles easily.
Exactly. And in the technical analysis world, staying above those averages is a classic strong buy signal. Plus, the XCD, the moving average convergence divergence, is sitting at a bullish 1.91.
Okay, let's unpack this a bit, because for the listener who, isn't drawing geometry on their stock charts every morning, what does a max CD of 1.91 actually tell us about the engine of this rally? Like, what is the mechanism there?
Sure. So MACD works by looking at the short-term speed of a stock's price versus its long-term speed.
Okay.
If the short-term speed suddenly overtakes the long-term, which is what we are seeing here, it tells us that fresh money is actively rushing into the stock right now.
Got it. So it is not just coasting on old momentum from like a month ago.
Exactly. The buying pressure has current immediate weight behind it.
That makes sense. But, whenever I see a chart that goes up this fast and this steep, I always think of a runner sprinting up a mountain.
That's a good way to look at it.
Right. Like, they're making great time, they look incredible, but they are burning immense energy. At some point, they have to run out of breath.
They absolutely do.
So what is the relative strength index, the RSI, telling us about their heart rate right now?
Well, the RSI is essentially that heart rate monitor. It measures the speed and change of price movements on a scale of 0 to 100.
Okay, and where are we on that scale?
Currently, the RSI is at 65.91.
Okay, so past the halfway mark.
Yeah. Conventionally, anything under 70 still signals a buy just because the trend is intact. However, creeping up to 66 means they are entering that high exertion zone.
So they are breathing heavy.
Very heavy. Once it crosses 70, the asset is considered overbought. That means the price has moved up way too quickly without a correction, and a pullback becomes highly probable.
So the runner is definitely panting. They aren't collapsing yet, but the strain is super visible.
Oh, the strain is very visible when you look at the underlying order flow.
What are we seeing there?
We are seeing intraday volume of roughly 349,000 shares, with strong buying pressure near the $57 support level. But there is a recent divergence occurring that serves as a really vital warning sign.
Divergence, meaning the price and the actual participation are moving in opposite directions.
Yes, exactly. The price of the stock increased, breaking to that new high of over $61, but the actual trading volume dropped while it happened.
Oh, interesting.
Yeah, mechanically, if a stock is hitting new highs, but fewer people are actually participating in the buying, the foundation of that rally is getting really hollow.
It's like fewer people trying to push the same boulder up a steeper hill.
That's spot on. It is a classic sign of potential rally exhaustion.
So the technical charts are warning us that buyer enthusiasm might be stretched a bit thin here.
Very thin.
And if the crowd is thinning out, the company's actual bank account has to do the heavy lifting to justify this $60 price. So let's open up their ledger. What does Ichor Holdings actually do, and how much cash are they bringing in?
Well, Ichor Holdings operates in the semiconductor capital equipment market. Specifically, they supply fluid delivery subsystems for semiconductor manufacturing.
Subsystems meaning what exactly? Like, break that down for me.
Okay, so they build the complex plumbing for the massive machines that manufacture microchips.
Plumbing for chips. Okay.
Yeah. When you make a silicon wafer, you have to hit it with highly corrosive gases and liquid chemicals in an incredibly precise sequence.
I imagine there's no room for error there.
Zero room.
Oh.
If the mix is off by a fraction of a percent, you ruin a wafer worth tens of thousands of dollars. Ichor builds the gas and liquid delivery systems that ensure that extreme precision. It is highly specialized hardware.
Got it. So they are basically the essential plumbers of the AI revolution.
That's a great way to put it.
And, I mean, plumbers usually make really good money.
You would certainly assume so. And looking at their trailing 12-month financials, the top line looks solid at first glance.
What are the numbers?
Revenue is at $947.65 million.
Yeah.
That is up 5% year over year.
Wow. Okay. Almost $1 billion flowing through the door. That sounds fantastic for a company with a market cap hovering around, what, $2 billion?
Yeah, roughly. It looks great until you read further down the income statement.
Uh-oh. Here comes the bad news.
Their net income is bleeding. They are down a painful $52.78 million.
Ouch. Wait, negative $52 million.
Yeah. Operating cash flow is also negative at minus $1.63 million. And their diluted earnings per share sits at negative $1.54.
That is rough.
They did manage to beat Q4 expectations with a surprise positive 1 cent per share, which is a nice little psychological bump, but overall it's a very tough picture.
Let me make sure I'm hearing this correctly. They are pulling in almost $1 billion in revenue, but they are losing over $50 million on the bottom line.
Yeah.
That is just baffling to look at.
It is, but you have to understand their business model.
Right, because they aren't selling software subscriptions where the money flows in predictably every single month. They are building the heavy machinery for chip makers.
Exactly. It's more like building cruise ships.
Right. You get massive paydays when an order comes in, but you have to survive these long, expensive droughts in between while you actually build the things.
That is a much more accurate way to look at the semiconductor capital equipment cycle. It is famously lumpy revenue.
Lumpy. I like that word for it.
Yeah, they rely on massive, sporadic capital expenditure orders from giant tech manufacturers. Think companies like Samsung or Intel.
Okay, and if those giants decide they have enough chip-making capacity for the year?
Then they pause their facility expansions. And when that happens, Ichor's revenue can dry up almost overnight, but their fixed overhead costs, the factories, the payroll, all that remains.
Which perfectly explains the negative net income. But, I mean, if they're burning cash like that, how are they keeping the lights on? A company can't survive negative cash flow forever.
No, they can't. The answer lies entirely on their balance sheet, which is really serving as their safety net right now.
Okay, what does the balance sheet look like?
What's fascinating here is ICHR holds about $71 million in cash against roughly $206 million in total debt.
$206 million in debt. Having 3 times more debt than cash doesn't sound like much of a safety net to me.
Well, in personal finance, it wouldn't be. You'd be in trouble. But in corporate finance, survival is all about liquidity. It's about when that debt is actually due and whether you can pay your immediate operating bills.
Okay, so what's their liquidity look like?
They boast a very healthy current ratio of 3.16x.
Meaning they have more than 3 times the liquid assets needed to cover their short-term liabilities for the next 12 months.
Correct. So they have plenty of runway. They aren't facing an immediate liquidity crisis at all.
Okay, that's a relief for investors.
What they are doing is essentially holding their breath. They are using that cash to survive the current cyclical trough in the semiconductor industry.
Waiting for the turnaround.
Exactly. Waiting for the anticipated 2026 AI hardware demand turnaround to trigger a massive wave of new factory orders.
So we have a company losing money right now, but supposedly positioned perfectly for an upcoming AI boom.
That's the narrative.
How do we properly value a business in that state? I mean, this naturally brings us to the big debate surrounding this stock. Let's look at the bull versus the bear case. Give me the pessimistic view first. Why are bears calling this a massive value trap?
The bear case focuses heavily on execution risk and current fundamentals, specifically looking at their margins. Right now, Ichor's gross margin is a razor-thin 11.45%.
Man, 11.45%, that is dangerously low for hardware manufacturing.
It leaves absolutely zero room for error. When your margins are that thin, one supply chain hiccup, one spike in raw material costs, or even a slight delay in a customer order, and you are immediately bleeding cash.
Right, there's no cushion.
None. So a bearish investor looks at this and says the stock is wildly overvalued right now. It has a trailing price-to-earnings ratio of negative 31.28.
Negative 31, yeah, that's tough to swallow.
The bears argue this $60 price tag relies entirely on aggressive future promises rather than current, proven reality.
But, the market is a forward-looking mechanism, always has been. The bullish outlook from our sources paints a very different picture of what tomorrow looks like.
Oh, absolutely. The bulls have a very strong counterargument.
Right. They argue that ICHR is in the middle of a massive strategic shift. Like, they are transitioning to use more internal components, and they are aggressively expanding their manufacturing capacity into Mexico and Malaysia to lower their production costs.
And the goal of that massive expansion is to push their gross margins to 16% by the end of 2026.
Which would completely change the math on their profitability. I mean, think about it. If you bump margins from 11.45% to 16% on nearly $1 billion in revenue, suddenly you have real sustainable cash flow.
You do. And the bull model suggests that if they hit those specific targets, they're actually undervalued right now by about 18%.
Wait, undervalued even at $60?
Yeah. The discounted cash flow fair value estimate, the DCF puts the stock at $70.82.
Let's clarify that DCF model for a moment, just for the listener. Discounted cash flow is basically a valuation method that tries to figure out the value of an investment today based on projections of how much money it will generate in the future, right?
That's exactly it. The bull models are projecting that once the AI-driven semiconductor upcycle truly kicks in, Ichor will generate so much free cash flow that $70.82 is a perfectly reasonable price to pay today.
Okay, but relying entirely on aggressive future promises is exactly how retail traders get wiped out.
It happens all the time.
They look at the AI horizon, they see a $70 price target on a spreadsheet, and they buy in, completely ignoring the massive execution risks of standing up new manufacturing plants in Mexico and Malaysia.
It's not easy to do.
It's incredibly difficult. You have to train new labor forces, establish new supply chain logistics, get the facilities up to standard. It rarely happens on schedule.
It is a massive leap of faith.
Yeah.
The bulls are basically betting on management's ability to execute this turnaround flawlessly in a highly volatile macro environment.
Well, if the consensus is a strong buy from the analysts, I'm assuming the executives are holding their shares tightly, confident in their own ability to execute? Are they?
That brings us to the most perplexing part of this entire analysis.
Yeah.
Let's look at the analyst community first, before we get to the insiders.
Okay, what are the analysts saying?
They're surprisingly united here. The consensus rating on Ichor Holdings is a resounding strong buy. We are looking at 6 buy ratings, 1 hold rating, and 0 sell ratings.
0 sells. Wow, that's rare to see across the board. But knowing how Wall Street works, I imagine there's a disconnect between the rating and the actual price targets.
A bizarre discrepancy, yes. Despite all these strong buy ratings, the average analyst price target is only $50.43. Even the absolute highest target on Wall Street right now is just $55.
Wait, the stock is trading at $60.60 right now.
Exactly.
So it has already blown past the most optimistic price target on Wall Street.
The price momentum has completely detached from the fundamental models. The market has run so far ahead that the analysts are lagging behind reality.
So what does that mean in practice?
It creates a scenario where analysts will either be forced to upgrade their targets soon just to save face, or it means the market has irrationally bid up the stock far beyond what the company is actually worth.
Here's where it gets really interesting. We've looked at the technicals, the financials, and the analysts, but the deepest clues usually come from seeing what the insiders are actually doing with their own real money.
The insider trading data is fascinating.
According to our sources, heavy insider selling occurred in February and March of 2026. The CEO, Philip Barros, sold approximately $3.5 million worth of shares.
And it wasn't just the CEO. The chief financial officer, Greg Swift, sold about $4.6 million worth.
So let me get this straight. We have a narrative that an upcoming AI upcycle is going to push this stock to $70 and beyond.
That's the bull story.
If that is true, why are the captain and the first mate taking massive profits and selling off millions right at the 52-week high?
This raises an important question about incentive and timing. Now, to be fair to corporate executives, insiders taking profits isn't automatically a death knell for a stock.
Sure, they get paid in stock.
Exactly. Executives receive a significant portion of their compensation in company stock. They have mortgages, they have kids going to college, and they need to diversify their own personal portfolios just like anyone else. Selling stock is a normal, scheduled part of executive life.
I mean, the idea that the CEO needs to sell $3.5 million just to pay for his kids' tuition is a bit of a stretch, but I take your point about diversification, but the timing is what really bothers me here.
The timing is exactly the issue. When you take millions of dollars in insider selling right at the 52-week high, and you combine it with that technical warning sign we talked about earlier.
The price going up while the trading volume drops.
Right, that divergence. When you put those together, it creates a glaring short-term weakness signal.
It really paints a picture that the smart money, the people closest to the actual spreadsheets and the daily operations, might believe that the current price has gotten a little ahead of the actual business reality.
Yeah, because if they truly believe $70 was an absolute guarantee in 6 months, they would likely hold.
Exactly. It certainly suggests a lack of aggressive confidence in the immediate short-term upside.
I would agree with that.
So, gathering all of this data, we have this massive technical rally pushing the stock to $60. We have a company bleeding net income but sitting on a decent cash runway. We have massive potential AI upside, but we have executives cashing out millions.
It's a lot of conflicting signals.
It is. Let's map this out for the listener. What are the actual short-term and long-term scenarios here? How do traders and investors navigate this?
Let's break it down into the best-case recovery scenario and the worst-case continuation lower. In the best-case short-term bullish continuation, the market's hunger for anything adjacent to AI semiconductor manufacturing simply overrides the fundamental concerns.
So the hype just wins out.
Pretty much. The upward momentum ignores the overbought RSI, pushes through current resistance, and continues to climb.
Yeah.
If it holds, we could see it test the $62 to $65 range in the coming weeks.
And what triggers the worst-case scenario? The bearish pullback.
In the worst-case scenario, gravity finally takes hold. The dropping volume and that high RSI cause the momentum to break. The buyers simply run out of cash to keep pushing the price higher.
And when that snaps?
If that happens, the stock will likely tumble down to test its primary Fibonacci pivot support at $57.39.
Let's clarify that term for a second. What makes $57.39 a Fibonacci pivot support, and why should the listener care about that specific number?
A Fibonacci pivot is basically a psychological and mathematical floor based on historical price retracements.
Okay.
Algorithm traders and technical analysts use these specific mathematical ratios to decide where a falling stock is likely to bounce. Because so many traders watch these exact levels, they become self-fulfilling prophecies. They program their buy orders around 57.39.
But what if the selling pressure is just too heavy and it breaks through that floor?
If it breaks below that support and broader market cyclical fears return, say, news comes out that chip makers are delaying new factories, it could easily drop back down into the lower 50s, erasing months of gains.
Wow. So we are sitting on a knife's edge here between a breakout to 65 or a plunge back to the low 50s. What is the actual event that is going to push it one way or the other? What is the next catalyst on the calendar?
Everything hinges on the upcoming Q1 2026 earnings announcement. That is scheduled for May 4, 2026.
So that earnings call is going to be the moment of truth.
It is where the narrative finally meets a ledger. That is where we will find out if that 16% gross margin target is actually becoming a reality through their new facilities in Mexico and Malaysia.
Or if it was just a pipe dream meant to keep investors optimistic while the executives quietly cashed out.
Exactly. If they report poor margins on May 4th, the market will punish the stock severely given how high it has run up.
It all comes down to execution. Okay, let's recap this wild journey we've been on today. We looked at Ichor Holdings, a company that builds the critical plumbing for the semiconductor industry, a stock that has roared from 13 bucks all the way up to 61 on the back of AI hype.
It's been quite a ride.
It boasts incredible upside if they can fix their margins, but it is currently haunted by negative cash flow, massive execution risks with international expansion, and millions of dollars in recent insider selling.
It is a textbook example of the tension between technical momentum and fundamental reality.
Yeah.
You really have to decide which one you trust more.
And that brings us to our final thought for you, the listener. We see the analyst telling you to aggressively buy, projecting a massive AI-fueled future where this company becomes highly profitable. But at the exact same time, the CEO and the CFO, the guys who see the daily production numbers, are quietly cashing out millions of dollars of their own holdings at the peak.
It's a huge contradiction.
It leaves you wondering, when the people actually running the financial spreadsheets decide the top is in, are you confident enough to bet against them? Let us know what you think in the comments down below. Are you bullish or bearish on ICHR?
We'd love to hear your take.
Thank you so much for joining us on this deep dive. Don't forget to like the video, subscribe to the channel, and we will see you next time.